According to Regulation 28 of the Pension Funds Act, retirement fund trustees should ensure members' savings are invested in a way that promotes the long-term sustainability of the value of the asset portfolio. So, what asset classes are available to retirement funds to comply with Regulation 28? It's important to note that there are also regulatory limits as to how much a retirement fund is allowed to invest in each asset class. To learn more, watch our video on prudential limits. Retirement funds can invest in cash, debt, equity, property, commodities, as well as alternative asset classes. Cash includes notes, coins, or any balance or deposit in an account held with a South African bank. These instruments are usually the safest to invest in, but they also offer low returns. Debt instruments include bonds issued by governments and public or private companies. Funds invested in these must be repaid to the investor by the debt issuer, typically at a fixed interest rate return. Debt investments carry the risk of issuers defaulting. To reduce default risk, debt investments are sometimes underwritten by banks, meaning they will stand in for defaults. Equity investments typically refer to an ownership stake in a private or public company. By owning equity, investors share in the dividends and capital growth of the company. Listed equity is available to the public and sold on stock exchanges, such as the JSE. Unlisted equity is sold to accredited investors. Equities returns are not fixed and therefore more volatile than debt and cash. By taking this additional risk, investors expect higher returns. Retirement funds can invest in property through direct investments in immovable property or through real estate investment trusts, REITs. Listed property funds, which includes shares in REITs offered by property companies. Commodities include Krugerrands and other commodities listed on an exchange, including exchange-traded commodities. Commodities are perceived as a riskier asset class due to price volatility linked to economic and market cycles. Alternative financial assets do not fall under the conventional asset categories. Examples include hedge funds and private equity. Alternative asset classes offer investors the opportunity to generate optimal risk-adjusted returns. This can either result in them beating returns on traditional asset classes or reducing risk associated with traditional asset classes. This is due to the unique investment strategies that can be used. However, investing in alternative assets can be complex and be subject to more volatility. To learn more about alternative asset classes, watch this video.